Negative bond yields is a most amazing phenomena. I mean, we have seen them once or twice before in past history, but this could be the making of a completely new environment for global bond markets and how investors respond. If it just is an issue for the current period of time because of worries about Greece, etc., that's one thing. But if it actually becomes permanent, so to speak, then I think the implications for how corporates issue and the sorts of equities that people buy, the higher yielding corporate debt that people buy, I think there could be some very, very significant capital flows that follow from this most unusual experiment which we're seeing in central bank policymaking.
With many central banks trying to compete on this, it smacks surely of the first signs of what you could call a currency war. Not all central banks can push their currencies down sufficiently to stoke up demand. So it is important, but I'm not sure it's the solution.
I think it's extremely significant. It has huge impacts on a lot of sort of simple things like pension funds, insurance companies, and how their whole model works, and it's putting them under a lot of pressure. And of course what that actually means, when people put under a lot of pressure, they take a lot more risk.
The ECB is buying a lot from bond markets. 25% of sovereign yields are negative. We have a black hole created in bond markets. Investors are looking for yield elsewhere.
It lowers the global cost of capital, so people are forced to go looking for a yield. Where they find that yield and implement it is obviously under question.
I think where I look at it from the high yield investment, it means that a yield of 2 or 3 or 4% suddenly becomes attractive if you've got a negative yield on your 5 and your 10-year government bond. I think it creates a lot of reallocation of resources and investing. There will be a portfolio effect from negative yields. How long they last for, though, I suspect will not be as long as the market is anticipating.
Well, I wouldn't put my money in a bond that has negative interest rates, but then I'm not being corralled by regulators to do that. For me, I think it's perfectly acceptable for a government to try and get a negative interest rate. Sounds a good deal. I think the problem is, why would investors do it? That's a very good question, because at some point there may well be a bond crash. So they'll either be near where they are or much higher.
As far as the US and the UK yields are concerned, I think they'll be moderately higher, because I think there's every likelihood that central banks in that sort of country will be either raising rates or trying to raise rates within a year's time. As far as German and Eurozone bond yields are concerned, I think where they are today are slightly lower. And the reason for that is very simply that the ECB's QE is going to be buying such a large part of these markets. I mean, about 3/4 or so of German bonds are going to be issued, that I think it's going to be very difficult for yields in those countries actually to move much higher. So a modest spread gap widening between those two parts of the world.
We think they're going to be probably a little bit lower than they are, even though they're quite low. So near zero for the 10-year yield for Germany is not unlikely.
In the United Kingdom, maybe marginally higher, but again, the growth seems to be tapering off slowly, while in Europe, it could potentially be a little bit lower.
10-year bonds near 10 to 20 basis points, and US and sterling 10-year rates 2% higher.
My estimate is UK, US will be up probably about 50 basis points. Germany will probably be down a further 20 to 30 bips.
German yields probably at the short end still likely to be where they are. US probably not as high as people think. In the UK, well, it depends on what happens in the election.
When I talked about Europe benefiting from QE, Europe will also benefit from obviously a lower exchange rate, and the get out of jail free card is low oil, and that's going to help growth everywhere. In the US and UK, we're at very good employment levels. At some point we're going to hit wage inflation, and it probably won't just happen gradually, it will happen quite quickly. And at that point we get close to a closer allocation of resources, which is close to full employment, and I think that will push up government bond yields around the world, and probably quicker than people think, because everyone has got so bearish at the moment.